Welcome to Roth IRA Investment Clarity, Stability over Speculation. In this video, we'll show you how to prioritize financial stability before chasing investment returns. We'll start by setting the right foundation, building an emergency fund and eliminating high-interest debt, then transition into how a Roth IRA works, why it can be powerful, and how to open and fund one. We'll also compare Roth versus traditional IRAs and finish with actionable steps you can implement today. Here's the roadmap. First, we'll explain why financial stability comes before investing. Next, we'll cover how to build an emergency fund and reduce high-interest debt. After that, we'll break down Roth IRA basics and show you how to open and fund an account. We'll then compare Roth versus traditional IRAs to help you decide what fits best. Finally, we'll give you an action plan and include quick quizzes to reinforce what you've learned. Before we begin, a quick disclaimer. This video is for educational purposes only and is not personalized financial advice. Your situation is unique, so please do your own research and consider consulting a qualified, fiduciary financial advisor before taking action. With that said, let's proceed thoughtfully and build understanding step by step. Let's set the tone. Stability should come before speculation. If you are new to saving or living paycheck to paycheck, the most impactful step you can take is to secure your financial base. That means establishing an emergency fund that covers 3 to 6 months of essential expenses and eliminating high-interest consumer debt. Once this safety net is in place, you can invest with confidence, avoid panic selling, and let compounding work in your favor over the long term. Here is your blueprint. Step 1. Build an emergency fund that covers 3 to 6 months of essential expenses. This belongs in a liquid, high-yield savings account, not in the market. Step 2. Eliminate high-interest consumer debt, especially credit cards or loans with double-digit APRs, because the guaranteed savings from paying those down typically beats the uncertain returns of investing. Step 3. Once stable, open a Roth IRA and automate contributions so progress happens even when you're busy. Step 4. Keep investing simple by choosing broadly diversified, low-cost index funds or a target date fund aligned with your timeline and risk tolerance. As we follow this sequence, you'll reduce fragility and increase the odds of long-term success. Let's get practical. First, list your essential monthly expenses: housing, utilities, groceries, transportation, insurance, and minimum debt payments. Next, calculate your target by multiplying those essentials by 3 to 6. If that feels overwhelming, build milestones. 1 month first, then 3, then 6. Open a separate high-yield savings account. Name it something like emergency only to reduce temptation, and set an automatic transfer that triggers the day after payday. Any windfalls, like tax refunds or bonuses, can accelerate progress. With this cushion in place, unexpected events won't force you to rely on costly debt. Now let's address high-interest debt. Start by listing all balances, interest rates, and minimum payments. Choose your strategy. The avalanche method focuses on the highest APR first for maximum interest savings, while the snowball method prioritizes the smallest balance to build momentum quickly. Commit to one method and automate extra payments toward the current target while paying minimums on the rest. To avoid backsliding, consider reducing card usage or even freezing a card temporarily. Eliminating high-interest debt frees up cash flow and reduces financial stress, making your investing plan sustainable. This decision flow starts by confirming whether your financial foundation is ready. If not, it routes you to build an emergency fund and pay off high-interest debt. If yes, it checks for an employer plan with a match, which is typically a priority because the match is essentially free money. Next, it moves to choosing between a Roth IRA and a traditional IRA. The deciding factor is your expected future tax bracket. If you expect to be in a higher bracket later, Roth contributions today can be beneficial since withdrawals are tax-free in retirement. If you expect a lower bracket later, a traditional IRA may be more advantageous due to the upfront tax deduction. The flow concludes with automating contributions and selecting low-cost index funds to maintain consistency and minimize fees. Let's compare the two main IRA types. With a Roth IRA, you pay taxes on contributions today, and qualified withdrawals in retirement are tax-free. This can be appealing if you expect to be in a higher tax bracket in the future. There is no required minimum initial deposit, and contributions are flexible up to the annual limit. Conversely, a traditional IRA may allow you to deduct contributions today, lowering your current taxable income, but withdrawals in retirement are taxed. If you expect to be in a lower tax bracket later, the traditional IRA might be more suitable. Both accounts offer similar investing options and benefits from automation. Here are some current IRA basics to anchor your planning. The annual contribution limit for those under age 50 is $7,000, subject to updates by the IRS. There is an additional catch-up contribution for those aged 50 and older, commonly $1,000, but verify current rules each year. You can fund the account with a lump sum, through monthly automatic deposits, or by contributing a portion of each paycheck. Many brokerages do not require a minimum initial deposit to open an IRA. Always verify current year limits before contributing. Opening a Roth IRA is straightforward. Start by choosing a reputable brokerage platform. Complete the Roth IRA application, verify your identity, and link your bank account. Next, schedule automatic contributions that align with your cash flow, weekly, bi-weekly, or monthly. Keep your portfolio simple with a broadly diversified index fund or an age-appropriate target date fund. Finally, enable dividend reinvestment so your earnings continue to compound. Consistency matters more than timing the market. Now let's discuss practical funding strategies. If your income fluctuates, try a paycheck drip. Contribute a small amount from each paycheck. Alternatively, a monthly auto deposit keeps things simple and predictable. If you receive a bonus, tax refund, or side income, consider a lump sum contribution to accelerate progress. Many people prefer a hybrid approach that mixes smaller monthly deposits with occasional top-ups. Start with an amount you can maintain confidently and increase it over time as your budget improves. This pie chart shows a simple example allocation within a Roth IRA. 60% U.S. stocks, 30% international stocks, and 10% bonds. The stock exposure drives long-term growth, while bonds can reduce volatility. Your exact mix should reflect your time horizon and risk tolerance, and some investors may prefer a target date fund that adjusts allocations automatically over time. This timeline emphasizes that you have an entire tax year, plus until the tax filing deadline of the following year, to make IRA contributions for a given tax year. To stay on track, use automated monthly contributions, perform quarterly check-ins to confirm you're on budget, and consider optional lump sum boosts when you receive extra income. This rhythm balances consistency with flexibility. Here are simple reminders. Use the formula emergency fund equals 3 to 6 times your essential monthly expenses. Track your progress with milestones: 1 month saved, then 3 months, then 6 months. As a rule of thumb, prioritize paying off very high interest debt, roughly 15% APR and above, before investing aggressively. These heuristics help you make consistent, rational choices. Quiz time. What should you prioritize before investing in a Roth IRA? Option A, maxing out contributions immediately. Option B, picking the hottest stocks. Option C, building a 3 to 6 month emergency fund and paying off high-interest debt. Option D, timing the market for a perfect entry. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is building a 3 to 6 month emergency fund and paying off high-interest debt. This foundation reduces financial fragility, so you can invest consistently and avoid having to liquidate investments during emergencies. Second quiz. Which statement best describes a Roth IRA compared to a traditional IRA? Option A, Roth pay taxes later, traditional pay taxes now. Option B, Roth pay taxes now with tax-free qualified withdrawals later, while a traditional IRA may offer a deduction now and is taxed later. Option C, both accounts are taxed the exact same way. Option D, a Roth requires a large minimum to open. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that Roth contributions are made with after-tax dollars and qualified withdrawals are tax-free later, while traditional IRA contributions may be deductible now and withdrawals are taxed in retirement. Your expected future tax bracket helps determine which account is more advantageous. Here are the key takeaways. Choose stability over speculation by building an emergency fund and eliminating high-interest debt first. A Roth IRA offers tax-free growth and qualified withdrawals in retirement, while a traditional IRA may provide a tax deduction today with taxes due on withdrawals later. Automate contributions, minimize fees, and keep your portfolio simple using broad, low-cost index funds or a well-chosen target date fund. To recap, first secure 3 to 6 months of essential expenses and defeat high-interest debt. Then open a Roth IRA at a reputable brokerage. There is typically no large minimum required. Fund the account in a way that aligns with your cash flow, whether as a lump sum, monthly contribution, or a small amount from each paycheck. Choose simple, low-cost funds and automate to stay consistent. Revisit your plan each year as contribution limits and your goals evolve. Thanks for watching. If this video helped you, please like, share, and subscribe. Share your questions and your Roth plan in the comments so we can all learn together. See you in the next video.